friends, welcome back to Random Gleanings. I am Chris. He is Jesse. Jesse, we got a low CPI print this morning.
We did. Not, still not where they want it to be, but I think the surprise was that it was lower than expectations.
Yeah, by 0.3%, right. That's a lot.
That's a lot.
So, yeah, it's moving the right way. It's still above 2, but it's moving the right way. And that's got stocks up today, which is kind of interesting. You found this chart.
Yeah, Charlie Bolello put this out showing that 2023 is yet to have an all-time high, okay?
Meaning stocks have not made it to their all-time high in 2023.
Which, coincidentally, 2022 had one, okay? That happened on January 3rd of 2022. So we're nearing 2 years. If we get a few days like today, we may see it by the end of 2023. But This would be the first year since 2012 to not have an all-time high if we don't achieve that by December 31.
And if you look back through history in the 60s and 70s, I mean, there are several really elongated periods where we did not have all-time highs. In fact, if you look at the 2000s decade, there was only 1 year with all-time highs, and it was 2007, right before
things came back down again.
Yeah. Got kind of gnarly in there. All right, so next chart. So here's what I find interesting. I mean, just dividend stocks, things you would think of as high quality. Another Bolello tweet. If someone told you 5 years ago there was a pandemic and that Pfizer would be the leading manufacturer of one of the vaccines, you'd probably assume they were going to outperform the market. And yet, nope. Down 16% and the S&P's up.
That's just hard to put our minds around, I think, very often. But that's what's happened.
So our friends at Bespoke, next chart, kind of tackled dividend stocks in general. So it's not just Pfizer. These are the 100 highest yielding stocks in the S&P. They're down 8% at least through yesterday. Which is fascinating to me. And in fact, I mean, we even owned a dividend holding ETF coming into the year, just feeling like dividends, total return,
high quality companies.
I mean,
why don't you go through a few of these high?
So I mean, I think about when I started in the wealth advisory business in 1995, and the types of companies you would want to talk about with folks. I mean, Amgen, Coke, Pepsi, Merck, Cisco, Home Depot, Texas Instruments, Chevron, Pfizer, Lockheed Martin, UPS, Philip Morris, 3M, U.S. Bank Corp, Valero, Kimberly-Clark, et cetera. I mean, these are very high-quality companies, and they've just been lambasted year to date.
Yeah.
So it wouldn't be surprising at all to me to see some reversion at some point, but boy, they just have not participated.
Yeah, I mean, and just to reiterate again, these companies are all paying a dividend, which you've said, I've read it before as well. You can kind of monkey with earnings from time to time, but you can't hide the cash flow that's going out to investors.
That's right. Cash is fact.
That's right.
Cash pays you, and if someone's sending it off their balance sheet to you, they're either going to run out of it or they can do it consistently.
Or they're managing it.
That's what these companies is. Which is, so to reiterate your reiteration, that's what blows me away.
Right.
If anyone thinks this year has been stable,
right,
or not
across
erratic,
the board, it's not been across the board. It's not been across the board.
I mean, look at these companies. These companies are great companies.
Yeah.
And in total, they're down. But I mean, today they're up a couple percent, which means now they're just down 5% year to date.
Right. Yeah.
Now the S&P's positive in a double-digit format, but again, if you look at that list of companies and say to yourself, well, golly, Pete, I wouldn't want to own those. No, you're just wrong. I mean, those are some of the bluest of the blue chip, high cash flow companies.
Again, 2023 will be for the record books of, diversion between the sectors of the economy. And this is a great example of that.
And in fact, I'll say this too. I mean, like more than half of the sectors in the S&P 500 of the 11 sectors are negative year to date.
I think 7, right? I think 7 of the 11 are still negative year to date. So it has been a really challenging year.
Without question. And it's also been challenging.
I was going to say that.
In the bond market.
You stole my segue, man. But yes, bonds have not only had a challenging year this year, they've been on a 3-year, run of challenging years.
Right.
You go back to 7/31 of 2020 at their all-time high. They're still off, roughly 26% through yesterday. It has not been friendly to the conservative side of your portfolio.
Well, this gentleman states that it is the worst bond market ever. Actually, that's not true.
Okay.
According to Bank of America Global Research, the worst ever was the year 1788 when they were down 20 to 30%.
You turned a year older today. Were you around for that?
My hair might indicate that. I do not have wooden teeth.
Okay.
But yeah, back that far. But yeah, I mean, you look at this chart, next chart, down 17% in 2022, worst since 1788.
It's brutal. It's brutal. But again, when folks are looking for conservative, spots to put their money or a diversifier away from the volatility of stocks, historically, you think bonds.
Yeah, you do.
And that just hasn't been the case for the last 3 years.
But the good news is, I mean, again, if indeed bonds ended negative this year, it would be the first time in history that U.S. Treasury bonds were down 3 years in a row. But that said, with a low CPI print, I mean, you're starting to see shelter inflation drop. I mean, ultimately, that probably means the Fed's done.
I totally agree with that. And one of the quotes coming off of that chart of 17% down or 3 years in a row was this idea of buy humiliation. I think you found some stats. And what I mean by that is when an asset class has been humiliated, right? Maybe that's the time to go buy it, right? It's the whole buy low, sell high. I think you found a stat in regards to, it goes back to the Golden tweet about what has happened after, these humiliating returns for
usually years 2, 3, and 4, when you have negativity for both stocks and bonds at the same time, are usually pretty good. But I mean, so yes, you would think to yourself that if inflation is rolling over and rates begin to pause, that you would get an opportunity to make money on bonds ultimately. In other words, not just the income, but also make money, capital gain from those bonds as well. And the folks at B of A go on to say, by humiliation, we believe that bonds will outperform in 2024 despite our structural negativity on the asset class. I'll come back to that in a second. But the outperformance will be driven by the most old-fashioned of reasons, a recession. Now, that's still up in the air, right?
Has been for 2 years.
It has been. That's right. I mean, our best strategist believed going into 2023, and by best, I mean their recommendations have had the best performance year to date. They believed we were going to have a recession in the first half, and then in the back half of the year, we would have recovery. And we would already be to that point if it were not for artificial intelligence stocks.
I think that's right.
Catching a bid. So, I mean, it's kind of dragging this out, unfortunately. Yeah. But suffice to say that, me personally, I mean, I would still think we end up having a recession at some point. I mean, of course, we'll always have one at some point.
There's always one looming out there. That's right, yeah.
But, I mean, man, just the level of interest rate increases has been so
It
strong.
has, and obviously the housing market is under a lot of pressure, and those things will catch up, I think, eventually as far as those costs. But we're not there yet, and we can celebrate a lower CPI day. So
I liked, on another topic, I liked this chart you put in from Nick Majuli about lifetime wealth ratio. I thought it was pretty cool.
I know you're a fan of ratios and just kind of keeping up with some of these things. So I'm using this as our planning topic for the week. So run this number for yourself. And I did it this morning after I saw it, and I went to my Social Security sheet through SocialSecurityAdministration.com to kind of calculate my lifetime income.
.gov.
I'm in a good spot, so I'm happy about that. But it relates kind of to your prodigious accumulator of wealth calculation, and this is just one I hadn't seen before. So
KPIs.
The point here is, just keep these things in front of you to understand: am I moving myself forward? Am I moving myself in the right direction? And so worth examining.
Good stuff. Yeah. All right, I told you I'd report back on lessons in chemistry. It is turning up. There's still a lot of chauvinism, but it's good. It's very good.
That's good.
I thought the protagonist was going to body slam her boss this last week, but and she kind of did.
Yeah,
mentally slammed him.
There you go.
But anyway, I won't tell you why. But you need to watch it. It's good.
Okay. All right. We'll check that out. I can't say I've watched anything good this weekend or this week, so we'll save something for next week. But thank you so much for watching. We appreciate you all tuning in. Please share it with a friend. Hit subscribe. Send us a note. All the good things. And look for us next week. Thanks so much. Take care.